Hello, this is part 1 of the Chapter 8 lecture series on accounting for bad debts using the direct write-off method. Let's get started. In Chapter 8, we will learn about receivables, which, remember from earlier chapters, represent amounts due from others. There are two major types of receivables, accounts receivable and notes receivable. We will discuss accounts receivable in this and the next video, and we will discuss notes receivable in the third video. Accounts receivable are amounts due from customers. It results from the sale of goods and services to customers on account. Remember from earlier chapters that accounts receivable is debited when a company provides a service to a customer on account. The appropriate credit is to service revenue. Accounts receivable is also debited when a company sells merchandise to a customer on account. The appropriate credit is to sales revenue. Companies choose to extend credit to customers with the hope that they will pay. Unfortunately, customers don't always pay. This means that some of a company's accounts receivable is uncollectible. We will use a new account in this chapter called bad debt expense to expense the portion of a company's accounts receivable that is uncollectible. We will also use the terms uncollectible accounts and bad debts interchangeably to refer to the accounts that are deemed uncollectible. There are two methods to account for bad debts, the direct write-off method and the allowance method. We will discuss the direct write-off method in this video and the allowance method in the next video. Under the direct write-off method, a company only recognizes bad debt expense when a particular account is identified as uncollectible. As an example, John, who owes Moonlight Company $300, went bankrupt and cannot pay his bill. To prepare the entry, we would debit bad debt expense and credit accounts receivable for $300, which is the amount that John owes Moonlight. We are increasing the expense account to recognize the bad debt, and we are reducing accounts receivable because we believe that we will never collect this account. This method of accounting for bad debts is not the preferred method for two reasons. First, a company typically identifies an account as uncollectible in a period after the sale is made, which means that expenses are not matched with the associated revenues. As in our example, Moonlight made the $300 sale to John on April the 16th, 2013. So the sale was recorded in April of 13. But Moonlight didn't discover that the account was uncollectible until March 12th of 14, so the expense is recorded in March of 2014, a different period than when the sale was recorded. Second, accounts receivable is recorded at its gross amount on the balance sheet without being reduced by the amount the company doesn't expect to collect. Thus, accounts receivable is overstated. For these two reasons, the direct write-off method is not permitted under GAAP. This completes part 1 of the Chapter 8 lecture series on the direct write-off method. Now let's learn about the allowance method.